Today is Expedia Group, ticker EXPE. Over the next 2 minutes, I'll discuss my thoughts on both the business quality and its valuation. This company has a market cap of $13.6 billion, enterprise value of $15.2 billion, so you can see about $1.5 billion in net debt on this business, only about 10% of the enterprise value. It tends to be pretty low here. This is a company in the internet and direct marketing retail space. And let's dive into the business description. They operate as an online travel company in the U.S. and internationally. Has a few brands, including brand Expedia, full-service online travel brand with localized websites. You had Hotels.com, Vrbo, online marketplace for alternative accommodations, Orbitz, Travelocity, cheap tickets, CarRentals.com, Hotwire, Expedia Cruise, various different websites where they can do different bookings. So they're making purchases through the internet and charging fees accordingly. They comprise travel agents, online retailers, metasearch. They also have online services through these other websites. So they have loyalty programs, hotel accommodations, various things like that. So it sounds like a pretty interesting business, probably something that has network effects, and you're operating kind of like a marketplace, not providing the actual accommodations yourself, but you're going to take fees from other people providing that. It should be relatively low expense in terms of returns on capital. We'll see how that plays out because they're just operating a website and working as the middleman. As we go down the return on invested capital chart, we can see a few things pretty clearly that besides recessions, they've done quite well. In 2008, they lost money, and then of course during COVID, they did very poorly. It looks like. With a significant drop to negative 19%. However, I want to look at this period from 2009 on. And what I see here is 7%, 10%, 11%, 7, 5, 8, 10, 2, 3, 3, 3, 4. These are not great return on invested capital numbers. I don't know why the returns on invested capital are so low for what is essentially just a series of websites. Being a booking service shouldn't be that hard to operate at a very high return on invested capital. One way that you could have this is if they've been making some acquisitions. I mean, they have quite a few different brands that I assume they had to buy over time. So it's building up some intangibles on the balance sheet, and that could be pulling these numbers down. What I tend to like to see here that kind of supports that theory is that you kind of have growing return on invested capitals, year after year until they're kind of brought down after a few periods. But like if you're just like going forward, you have a lot of times where it just steadily improves over time, and that's showing that maybe things are getting better and better, but the intangible side of the balance sheet is probably drawing it down. Now, when we go to the key statistics, though, I mean, these are not great returns. Return on invested capital, 4%. Return on equity of 8%. These should be substantially better. I'm going to have to do a deep dive into the balance sheet because I expected this to be a really, really good business. I mean, you can see the gross profit here at 81% median margins. That's a very strong number. It's what I'd expect. But then low EBIT margins, low free cash flow margins compared to this gross profit, these should be much higher. Now, you do have nice growth, revenue growth here of 10% a year, asset growth of 12%, free cash flow growth of 17%. You see some operating leverage here. I don't like that the assets are growing faster than revenue, but because you're growing your free cash flow at a higher rate, that's okay. But something is clearly off in terms of what the book value is showing because we're seeing price to book of 3.4, return on equity of 8.1%. You also see that this number doesn't really match up with the PE. If you were to divide 3.7 by 8.1, it's going to get you in the 2 range. And so you have a much better price there. So it's just very complicated what we're seeing in this. It's going to take some look at these balance sheet and other income statements in order to get a handle on what's going on. The other problem here too is these last 2 years are going to distort our 10-year numbers to a significant degree. Because they're so negative. COVID is such an abnormal year, but it's important for you to think about as a potential investor in this company because it could be that something has permanently changed in the travel industry. I don't think that is true, but it shows clearly the risk that you have with a company like this dependent on travel. EPS, $2 in earnings per share, and basically they got up to $3.77. They would probably have been right around $4 if you didn't have COVID. So maybe they doubled EPS over the course of a decade, maybe a 7% growth. It says that you've taken your revenue up, 10%. You've doubled it from 2012 to 2021, but it's actually much better than that because what you did was from 2012 to 2019, you tripled it over a 7-year period, which is a very, very impressive revenue growth rate. It's actually much better than your asset growth rate at that point. So that's why you're getting the operating leverage, because your revenues are growing faster than your assets. It's just the last 2 years that have really distorted what we're seeing from these numbers. I mean, you can see the massive growth in gross profit, strong margins all the way through. But it's why something like this negative 56% revenue growth from COVID just was absolutely killer for them in turning a profit. It's nice that they did turn an operating profit in 2021 despite still being below their peak by a substantial degree as well. I still don't understand where all this cost is. I mean, you have 10,000, what is this, $10 billion in gross profit, and you hardly get $1 billion in operating profits. To have 90%, to operate $9 billion in operating expenses is very high. We're going to have to dive into that. They are paying a dividend, which is a good sign, but they did cut it during COVID. Let's see what we can see. So if you enjoyed this video, hit that like button. Don't forget to subscribe. At the end of the video, I'm going to link to every company in S&P 500 that I have enjoyed that hit my watch list. We have yet to determine if this one will, but we're going to see very soon. So let's look at the income statement. Now, where are all these expenses going? So you have very high operating expenses, SG&A here, very high expenses. SG&A is not under control. They're spending probably way too much on SG&A. This has to be, is it marketing? It might be marketing. You'd have to do a deeper dive on their actual long form documents. But they're just spending a significant amount of money on SG&A, and it's preventing them from really having their operating profit grow. I mean, they tripled their gross profit and they didn't even double their operating profit, which is really sad. I mean, can you imagine if they'd taken this and they held that SG&A in check? That would have been astronomical. The big question is there something wrong with their business? Do they not have as good of a moat as their cost of goods sold would present it to us with this high gross profit, because they're having to spend money here? Where is this going? Is it employees? That's what you really need to understand. They've been able to hold their R&D, research and development, a little bit more in check. But again, this is just going through the roof. They were able to drop it significantly during COVID. Makes you think that it is some sort of variable cost that management can control. But again, just very, very high numbers there. Let's see. So they've diluted you about 8% over the course of the last decade. It's not terrible, because what you can see is they were basically flat through 2020. But they do have dilution here. They diluted 10% over the course of a few years. They bought back some of their stock, it looks like. But then they're back up to, an 8% dilution over the course of a decade. Not great, but it's a little less. It's less than 1% per year in terms of what it's going to do to you. As long as it's below 1% per year of dilution, it's not terrible. It means they're handling it somewhat in check. But again, these net income numbers are not huge. I mean, our highest net income number for the whole decade was $764 million. And you're trading at like 20 times your highest overall earnings, and you're not back at that yet. So just a little bit of concern on terms of what the valuation is set at. But we're going to have to see a little bit more. Now, you can confirm kind of what I was thinking here is that this assets, you have a lot of intangible assets here, because they don't have that much PP&E. A website here, $2.5 billion, $3 billion. That's only 15% of their total asset base. You have a lot of cash. You have some other current assets. I don't really know what they are. Some account receivable. But then you have, $8 billion in intangibles between goodwill and other. And so that's holding down the return on equity. Now, it's still not amazing. I mean, if you take that out, if you take out the $4 billion in cash, take out $12 billion, now you're at like $8 billion in earnings. And you say $8 billion versus a 5%, $500 million, maybe that gets you to a 16%, not even 16%, like an 8% return on invested capital. And then the return on equity gets double digits. So you're better than it looks on a return on invested capital basis, return on asset basis. But they have been having to dump a lot of money here into acquisitions that you need to take into account somehow, and that's what that number is doing. They're not getting a very high return on their acquisition numbers because that's what the goodwill is building in. And so you should be aware of it, that as the company's making acquisitions, it's probably not great for you as a shareholder based upon how these numbers are playing out. Maybe if you believe in long-term future pricing power, that can play into it. But it's something to be aware of. I mean, they 5x their debt. I mean, $1.2 billion to $7.7 $7 billion over the course of a decade. That's a lot of extra debt on this business. Again, you have you have cash here offsetting some of this, but still a lot of debt to be paying interest rates on. If you're making $500 million a year and you have $7.7 billion in debt, you're talking 12, 14 years worth of debt based upon their operating profitability. Not great. Not great here. So cash flow statement, let's see if we can see a bit more. Okay, so one thing I like here is, again, not with every company you see, but you see that their cash flow from operations is healthy and strong and is almost always exceeding its PP&E investments, not always exceeding its acquisitions, but of course on a normalized basis they are. So they're keeping this cash from investing below your cash flow from operations. There is the positive cash flow that I like to see there. They are doing, is this buybacks? Yeah, it looks like they're doing some buybacks here, pretty steady buybacks, but they're having a lot of stock-based compensation, and that's really where the dilution is. I mean, this is a huge amount of stock-based compensation, because what's really happening with these buybacks is a lot of times they're not even offsetting the dilution. I mean, you have been buying back shares with a significant. I mean, you bought back more money than your net income in many years in terms of buybacks, and yet you still have dilution. So where did the money go? Because you think about all this money that was spent on stock buybacks, and yet you have more shares outstanding at the end of the decade than you do the beginning. This is basically becomes, payoff to employees, to management. Whoever's getting those stock-based compensation is getting paid from this cash flow. And yet the cash isn't then available to shareholders. So where did it all go? And it's basically wiping out, what looks like a decades of earnings simply on this. And yet you didn't gain any greater ownership in the business. That's a really poor sign to me of the capital allocation, that management is overpaying to basically buy back shares that they're issuing to themselves. There could be good reasons for it. Again, this is a simplified look at it, but it's just, they have cash flow from operations. It's just not being used in the way that you'd like to see there. They are taking on continuing amounts of debt. So they've had to increase their debt. They've been paying out a bunch of cash as common stock buybacks, and yet you don't have that shares outstanding going down. Now, they do have dividends, but they ended those dividends. I'm really surprised. I thought Expedia was going to be a really interesting company, but they're not earning very high returns on invested capital. In order to grow at these rates, it's going to take them diluting themselves. It's going to take them issuing new debt because they're not earning high enough returns on capital. Now, again, some of this is goodwill and those intangibles. Once you take that out, the numbers look better. It does get this into a double-digit range, but it's not outstanding. And yet for all of this, you're paying an expensive price. This is not a cheap price. I mean, you think about this, and over the last, since 2016, they've never earned more than a 5% return on invested capital. So 6 years with less than a 5% return on invested capital, and yet you're paying 25 times earnings for that, 24 times earnings. I don't know. For me, I would be hesitant. I thought this was going to be a company that would hit my watch list, but at this time, I'm going to pass on it because I just cannot predict the future well. I don't like the heavy money being spent on acquisitions. This is really a capital allocation problem to me. It's not a business problem. You see the gross profit here. You see that it's really business management in how the business is being managed. It suggests that maybe the moat's not as strong as you would think because they're having to spend so much money on SG&A. If the moat was better, the SG&A should not have had to increase as much as it did. As again, we saw this SG&A just skyrocketing over the course of a decade. It tripled. And I don't understand why they needed to do that unless the business isn't as strong as their initial gross profit numbers would suggest. They're not getting the returns on assets that I'd like to see. I mean, this is basically some websites functioning as a travel agency arm, and it's not work. The economics aren't showing up in their balance sheet and in their income statements. So for me, I pass. Hope you enjoyed this video. Hit that like button. Don't forget to subscribe. If you'd like to learn how to use this software that I'm using, it's quickfs.net. The first link in the description below is my affiliate link. Please consider using that link to sign up. You can get a free or paid account. It's no extra cost to use my link, but it's a great way to support the channel because I can get a commission if you decide to make an account. This is software I use for myself. And don't forget that if you want more great videos on this topic, I have a link to my favorite S&P 500 companies in the playlist up above. These are my watch list stocks that I have found. I hope you'll check those out. Until next time, stop paying fees, start building wealth.